Hello friends, welcome to my weekly market outlook video. I'm Vijay Bhambwani, and in this video we are going to talk about what to expect from the market next week. My apologies for not having made a video last week, but I was really down and out. You see, I trade commodities. The markets work for 15 hours a day. A little bit of more research before the markets open, reading and writing, etc. I have an 18-hour work schedule, and the exhaustion can really get to you. Thank you for some of you who've asked about my well-being. I'm truly touched. I'm fine. I'm okay. And I'm back with you all over again. So let's dive right in and let's see what the market did last week and thereon guesstimate as to what to expect in the coming week. Coming up on your screen is the market roundup window. What you can see is that the Nifty outperformed the Bank Nifty in relative comparison. Oil fell partly due to OPEC's meeting on 4th of November, wherein an output hike of 400,000 barrels per day was announced, which was along expected lines, of course, and also partly because of a strong US dollar. The rupee managed to outperform the US dollar, which means even though the dollar strengthened against the global basket of currencies, the rupee strengthened against the dollar itself, which makes the rupee a relative outperformer on a week-on-week basis. And this is also part of the reason why the Indian markets recouped some of the prior week's losses. The 10-year benchmark bond yield fell slightly, which was positive for banks and the Bank Nifty itself. The NSE saw 2.23% gain in market capitalization, which means the value of all the shares quoted and listed on the NSE itself, compared to a big sell-off in the prior week. The MWPL chart on your screen shows a routine rise in the market-wide open interest, which, as I said, is routine after the expiry. And it may continue to rise till the third week of this derivative cycle. The index and stock futures volume chart on your screen now, do remember this is cumulative November, December and January series futures volume. It shows a sharp plunge. The last day where the volumes have almost, I'm saying almost, gone to zero is because of the token 1 hour Mahurat session, which of course is routinely a very low volume day. But even if you were to discount that fact, volumes have fallen on a week-on-week basis. Trader participation was curtailed, and we need to watch this aspect of the market very keenly. Friends, I put up this data of volumes and MWPL every day on my social media accounts. Do feel free if you care to connect with me. My contact coordinates will come at the end of this newsletter, and you can update yourself with this data on a day-to-day basis. Now, the basis chart on your screen, which shows the futures premium over the spot indices. Now, frankly, this is a worry for me, and I think even for the bulls. In spite of this being the first week into the new derivative cycle, the Nifty futures is in inversion zone. Inversion meaning inverted, ulta, upside down. So the futures are actually trading at a very small discount to cash. This shows a selling bias. Not a good sign, but of course things can always improve at a later date. Bank Nifty also shows a sharp contraction in basis. This is also due to selling at higher levels. And do note, and this is again something you need to concern yourself with, how the steepest fall in basis has come on the Mahurat day itself, which traditionally is a day of token buying on sentimental grounds. Now there's been profit taking on Mahurat day. I'll touch upon this a little more at a later date along with visual evidence. And we'll see why this Mahurat session was important and why I have included this data even though it was token in nature in my weekly video. Now, let's go to the Impetus chart, which is a bedrock of reliability and accuracy of market trends from our exclusive in-house statistical model, the IBEX. I assure you this study you will not find anywhere else in the free domain. We of course have dozens and dozens of more in-house indicators, which I assure you I will be sharing with you in my future videos. Now for the Impetus chart. The Impetus chart very clearly shows the Nifty remaining subdued. And for the bulls to have an unmistakable advantage over bears, the price and the Impetus chart must rise simultaneously. Otherwise, the rally is suspect. I keep posting this Impetus chart periodically on my social media accounts whenever the situation demands. Now the bulls need to show more firepower to get their mojo back. So let's watch what they do next week. Can the Impetus pick up? Yes, of course it can. This is the market. Trends reverse, trends turn, trend extends. So anything is possible. Let's keep our ears to the ground for signals that emanate from the market. Friends, let's now go to monitor the footprint of the various market participant types, because it also gives us a very critical aspect of what's happening in the market, who's doing what. Now, the FIIs were net short in index futures to the extent of 51,779 lots against the previous week's net short of 34,359 lots short. The stocks, their stock futures longs have come down to 7,911 from previous week 17,912. So clearly the FIIs seem to be a little circumspect. Where DIIs, the domestic investment institutions, are concerned, they are unmistakably hammering their way away. So their index shorts are now up to 85,544 lots as against previous week's 83,375 lots short. Their stock futures shorts have also gone up to 15,52,566 lots as against last week's 15,39,337 lots. Now here again, the DIIs have been basically hammering the market away. So the institutional side of the market seems to be circumspect, seems to be suspicious of an up move, and is actually selling. Let's take a look at what prop traders are doing. Now, these are brokers' own proprietary trades, and this is the next best thing to insider trading because they know exactly who's buying and how much. So the brokers' proprietary index futures net longs went down to 26,668 lots against last week's 30,269 lots. Their stock futures net longs went up to 2,49,097 lots as against 2,30,428 lots last week. So the prop traders are circumspect on the indices, but they've given a vote of confidence on the individual stocks. Retail traders. Now, this is extremely interesting because so far the retail guys have been doing all the heavy lifting and powering the market rally. So retail traders have stepped up their index futures net longs to 50,965 lots as against last week's 35,194 lots. Their stock futures longs have also gone up to 13,55,248 lots from last week's 13,43,268 lots. So you can see that whatever the FIIs and the DIIs are selling, the retail guys are buying with a little help from prop traders. Now, friends, I promised you I would touch upon the Muhurat session trading, wherein I told you I have some update for you on this front. Well, the retail guys have displayed a preference for intellect over emotion. and chosen to book profits on long positions on Muhurat day. Rather than buy in a token amount on sentimental grounds, these guys are actually locking in gains. Now, this is healthy, and profit taking empowers you to re enter on the long side at lower levels because you've released your money, and the retail guys have shown tremendous amount of objectivity here. Way to go, guys. Continue playing the markets well. Friends, let's now come to Mr. Moneybags, the bond market. This is the market that provides the finance for all other asset classes. And don't let anybody convince you otherwise that the bond markets are unimportant. You don't need to monitor them, etc. Because this is what controls the leash of money supply to the other asset classes. So the bond yields, though remaining in the upper end of the annual range, as you can see on your screen, has kind of cooled off on a week-on-week basis. The currency peg, which is the Indian rupee versus the US dollar, is also showing resilience of late. Both are positive indicators for our markets, of course. We need to keep watching the geopolitical developments very keenly in the coming weeks because there could be a lot of clues about market trends emanating from there on. Now, a fortnight ago, I told you in my segment of what's hot and what's not that the credit crisis in Chinese bond markets, especially real estate companies' bonds, would actually filter down to inflows in the Indian sovereign debt and corporate bond market, which is what you are seeing. Bond yields having fallen, which means the bond prices are up due to interest from overseas. Now, oil prices are something else that I would advocate watching and monitoring very, very keenly because inflation and bond yields will, of course, be determined based on oil prices, as will the outlook on the Dixie, the US dollar index. So, which is exactly what we are going in for now. Let's take a look at what the Dixie did last week. The currency benchmark gained on a week-on-week basis, though it fell on 3 out of 5 trading sessions. Note on your screen how the daily chart shows the price staying above the 93.5 level, which I was talking about for many, many weeks. And the same level is marked by a red dashed line. The price stayed above this level and also above its 25-day exponential moving average, which marks approximately a month-long average holding price of the bulls. As long as the price remains above the 25-day exponential moving average on the daily chart, the bulls are likely to hold on to their existing long positions. Now, a strong Dixie, which is the US dollar index, is negative for all emerging markets, including India. And let's now flip to the weekly chart, which shows the 94.5 level acting like an immediate but a very short-term hurdle. Any sustained trade above the 94.5 level may trigger more upsides, and this will have implications on energy, which is oil and gas, bullion, which is gold and silver, and industrial metal prices. A stronger dollar would mean weaker commodity prices and by default higher inflation. Imported inflation for emerging markets, that is. Now, by default, it will also have an impact on our bond yields and a trickle-down effect on our equities. Now, the coming week is likely to see an estimated, I stress upon the word estimated here, a range between 95.15 on the upside and 93.25 on the downside. Friends, the Dixie done. Now let's go to the Nifty 50, which gained 1.17% last week and underperformed the Nifty 50 in relative comparison. Because worldwide fears of sticky inflation and turbulence in the bond market kept traders on the edge of their seats. Look at the daily chart on your screen. The index gained on 3 out of 4 trading sessions in a holiday shortened last week. Now, the price stayed above its 25-day exponential moving average, which is approximately 1 month long average holding cost of the bulls, which means the short-term outlook is positive for now. Watch this average for support in the coming days. Do note the average will keep rising, so the bulls must keep the prices rising faster than the average rises. The weekly chart on your screen shows a small bullish candle contained within the prior week's bearish and large candle. This indicates a pause in the price action. Note that the falling impetus we saw earlier, that ties in pretty neatly with the outlook of the daily weekly chart of the Bank Nifty. A breakout or a breakdown beyond the big red candle of the week prior to the last will pave the way for the next wave of the price action. That candle's high and low, the range, weekly range, was 41,829 and 38,426. Now, that's a pretty big range because the candle was a big bearish candle. The price is comfortably above its 25-week exponential moving average, which is roughly 6 months of average holding price, which means even the medium-term bull is comfortable holding out for now. In the week before last, this index was number 4 on the most volatile counters list, but moved up 1 notch to number 3. Now, this shows that the statistical beta or the share price volatility is rising, and I have been posting pictures on my social media account about how rising statistical beta and the widening spreads on your snapquote window is going to provide a challenge to the bulls. As a matter of fact, I also covered it in my recent video. So the spreads are unusually wide, and that's a challenge for retail traders, and which is why you should be trading light, keeping stop losses absolutely diligently. The coming week is likely to see an estimated range between 41,075 on the upside and 38,075 on the downside. Trends are fickle and spreads remain wide, so let's be careful out there and trade light. Friends, let's now go to the Nifty 50, which gained 1.39% on a week-on-week basis. And this index gained on 2 out of 4 trading sessions in the holiday shortened week. Take a look at the 1-minute chart. Now, this is an additional chart or a study that I have put in this week's video. This 1-minute chart is to draw your attention to the sheer volatility that I saw on 3rd of November between 3 minutes past 2 p.m. and 10 minutes past 3 p.m. IST. Now, it made a peak at 3 minutes past 2 p.m. at 17,935 and went to a low of 17,770 exactly at 2 p.m., 32 minutes past 2 p.m. Now, that's a fall of 165 points in 29 minutes flat. That's not all. Then a rally started from 17,770 all the way up to 17,886 by 10 minutes past 3 p.m., which is a gain of 94 points in 38 minutes flat. Now, this tells me that statistical beta or pure price volatility is likely to be escalated and it might persist for a while. This requires special agility on the part of the trader because volatility can cut both ways, and the trader must be prepared to reverse trades at a moment's notice. So, very high volatility, my friends, is the new normal. It's something that you'll have to cope up with and be very, very careful about. Let's now take a look at the daily chart of the Nifty, where the price is poised at the 25-day exponential moving average, which means the bulls are witnessing the current market price being close to their monthly average holding price. Any further dips, especially closings below the 25-day exponential moving average, can trigger more nervousness in the near term. Now, the recent swing low, which was made on 29th of October 2021 at 17,613 level, needs watching. Bulls will need to defend this level in case of declines in the coming weeks. Now, the weekly chart on your screen, it shows the price making a small bullish candle contained within the prior week's candle, exactly like the Bank Nifty. And I am sharing the range of the previous bearish candles, large bearish candles, high and low, which is 18,342 and 17,613. We need a move beyond these parameters to trigger the next wave of price trends. In the week before last, the index was at number 16 on the most volatile list on the NSE, but it rose 4 notches to number 12 because volatility has been climbing. Now, this raises the challenge for a short-term trader, especially intraday and micro-trend traders. And the coming week, I expect estimated, I stress upon the word estimated, friends, range between 18,400 on the upside and 17,450 on the downside. I advocate trading as light as possible in the days ahead because volatility and spreads remain high. And wide spreads are actually a big challenge for day traders. Now, let me share a couple of thoughts on what can worry the markets. Friends, what I saw on Friday in the news media actually worried me because not only did OPEC refuse to raise oil output beyond the pre-announced 400,000 barrels per day, but they also raised the OSP, which is the official selling price of crude oil across the board for Asia, Europe, etc., by over $2.50 a barrel. Now that is big. That's big and that's inflationary. Now this is something that has come beyond the market trading hours on Muhurat session and in all probability get factored in on Monday morning. So volatility is likely to remain high. Chances are the bulls might just shrug things off and go on as business as usual, but let the prices tell us where it wants to go. Till then, the markets are likely to be tentative. Volatility will remain high and it's going to be a challenge. Friends, I come to the end of this video. In the end will be my contact coordinates where you can connect with me. But if you liked what you saw in this video, please subscribe to my YouTube channel if you haven't already done so. In the comment section, do let me know what you think about my work and how it helps you become a better Nifty and Bank Nifty trader. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And please help me reach out to fellow like-minded investors and traders by referring my video to your family and friends. Also in the description below the video are my hyperlinks to my playlist on Equity Masters YouTube channel. I put up a couple of ideas over there as well. Do subscribe to that channel and avail of a free trading guide. Thank you for your patience, my friends. Thank you for watching my video. And till we meet again in my next, this is Vijay Bhambwani signing off. Have a very, very profitable week ahead. Take care. Bye-bye.